Have you ever wondered why some people seem to make money effortlessly from investments while others struggle? It's a question that baffles many, and the answer lies in understanding the investment paradox. At its core, investment is about putting your money to work for you, hoping for a profitable return. But here's the paradox. While everyone wants to make a profit, not everyone is successful. Why? Because investing isn't as simple as buying low and selling high. There are common misconceptions that cloud the investment landscape. Some believe it's all about timing the market, others think it's about picking the right stocks. While these elements can play a part, they aren't the heart of investing. Understanding investments isn't just about knowledge of the market. It involves comprehending the risk, the potential return, and your own financial goals. Investing might seem like a game of luck, but it's much more about strategy and knowledge. One of the most powerful tools in investing is something called compound interest. Picture this. You're planting a seed in your garden. Over time, it grows into a mighty tree, producing more seeds that fall to the ground. These seeds then grow into their own trees, and the cycle continues. This is the essence of compound interest. Your money, like a seed, grows and multiplies over time. So how does compound interest work? Simple. It's interest on interest. Let's say you invest $100 with an annual interest rate of 5%. After the first year, you'll earn $5 in interest, bringing your total to $105. Now the magic happens in the subsequent years. Instead of earning interest on the initial $100, you earn interest on the new total of $105. This cycle repeats year after year, your money growing exponentially rather than linearly. Let's delve into a real-life example. Meet Jack and Jill. Jack starts investing $1,000 a year at age 25, while Jill starts at 35. They both retire at 65 with the same annual return of 7%. Despite investing for 10 fewer years, Jack ends up with nearly twice as much money as Jill, thanks to compound interest. This simple concept turned his 10 extra years into a significant monetary advantage. Now, what are the long-term benefits of compound interest? Essentially, it's a way to grow your wealth without additional effort. Your money works for you even while you sleep. It's a snowball effect. The more you have, the more you earn. And the longer you let it compound, the faster and larger your wealth grows. However, it's crucial to remember that the power of compound interest isn't unlocked overnight. It requires patience and time. Think of it like a fine wine. It gets better with age. The more time you give your investments to grow, the more you'll reap the benefits of compound interest. With compound interest, time is your best friend. The earlier you start, the better. So why not start today? Your future self will thank you. Now, let's talk about diversification, an essential strategy for reducing risk. Imagine you're a farmer. To ensure a good harvest, you wouldn't just plant one type of crop, would you? You'd plant several varieties to hedge your bets against pests, disease, or adverse weather conditions. This, in essence, is what diversification is all about. It's about spreading your investments across various assets to minimize the risk of a single investment's poor performance significantly impacting your overall portfolio. To illustrate, let's take the age-old saying, don't put all your eggs in one basket. If you invest all your money in one company's stock and that company goes under, you could lose everything. But if you spread out your investments across a variety of companies and sectors, the poor performance of one company won't tank your entire portfolio. Instead, the gains from other investments can help offset the losses, keeping your portfolio healthy and balanced. But diversification isn't just about investing in various companies. It can also mean investing in different asset classes. Stocks, bonds, real estate, or commodities, each comes with its own set of risks and rewards. By diversifying across different asset classes, you can further hedge against market volatility and create a more resilient portfolio. However, bear in mind that diversification is not a one-size-fits-all strategy. It depends on your risk tolerance, investment goals, and time horizon. A young investor with a high risk tolerance might lean more towards stocks, while a retiree might prefer safer investments like bonds. And remember, while diversification can help mitigate risk, it's not a magic bullet. It doesn't promise high returns, nor does it protect against all types of risk. For instance, during a broad market downturn, almost all stocks may decline, regardless of how diversified your portfolio is. In conclusion, diversification is like a safety net. It won't prevent falls, but it can help cushion the impact. It's a key strategy for navigating the unpredictable waters of investing, providing a balance between risk and return. Diversification doesn't guarantee profits, but it does help manage risks. Consistency and discipline are key in the world of investing. Now you might wonder, what does that mean exactly? Well, let's delve into the concept of regular investments. Imagine you're a gardener. You wouldn't just plant a seed and then ignore it, would you? Of course not. You would water it regularly, make sure it gets enough sunlight, and check on it frequently. The same principle applies to investing. It's not a one-and-done deal. Instead, it's a process that requires regular attention and consistent action. Making regular investments regardless of market conditions is a tried and true strategy. It's like setting up an automatic drip irrigation system for your investments. Whether it's raining or shining, whether the market is up or down, you keep watering your investments. This strategy is known as dollar cost averaging. It's a fancy term that simply means investing a fixed amount of money at regular intervals. For example, you might decide to invest $100 every month, come what may. When the market is down, your $100 buys more shares. When the market is up, it buys fewer shares. Over time, this can average out the cost per share of your investments. But why does this matter? Well, dollar cost averaging can help mitigate the impact of market volatility. It takes the emotion out of investing. You're not trying to time the market or predict its movements. Instead, you're committing to a consistent plan, regardless of the market's ups and downs. It's like going on a long road trip. You don't wait for the perfect weather conditions to start driving. You just get on the road and keep going, adjusting your speed as needed. Similarly, with regular investments, you get in the market and stay in, adjusting your investments as needed. Remember, the goal of investing is not to get rich quick. It's to grow your wealth over time. And regular investing, with its consistent and disciplined approach, can help you do just that. It's a simple yet effective approach to building wealth. Regular investing can offer a simple and effective approach to growing wealth over time. So keep watering those investments and watch them grow. Investing and speculating might seem similar, but they are fundamentally different. Let's start with investing. It's like planting a seed and patiently waiting for it to grow into a tree. You're putting your money into assets that you believe will increase in value over time. It's the long game, built on research, patience, and a dash of optimism. Now, speculating is a different beast altogether. It's more akin to gambling. Speculators place high-risk bets on assets, hoping for quick, substantial returns. The stakes are high and so are the potential rewards, but the losses can be just as significant. Here's the deal. Investing is about building wealth steadily and surely. It's about understanding the market, making informed decisions, and having the patience to let your investments grow. Speculating, on the other hand, is a high-risk, high-reward game that requires a strong stomach and the ability to absorb potential losses. Remember, investing isn't about getting rich quick, it's about building wealth steadily and surely. Let's recap what we've learned today about investing. We kicked things off with the investment paradox. It's all about understanding that investment is not just about gaining wealth, but also about protecting what you have. It's a delicate balance between risk and reward, and understanding this paradox is the first step in your journey to financial freedom. Next, we dove into the power of compound interest. Remember, it's not just about the money you invest, but also about how long you let it grow. With compound interest, your money works for you. It's a snowball effect that can lead to substantial growth over time. It's like planting a seed and watching it grow into a mighty tree. The earlier you start, the bigger your financial tree can become. Then we discussed the importance of diversification. By spreading your investments across different asset classes, you can mitigate risk and potentially increase your overall returns. It's like not putting all your eggs in one basket. Diversification can help you weather the storm during volatile market conditions. We also stress the importance of regular investments. Consistency is key in the world of investing. It's not about timing the market, but rather about time in the market. Regular investments can help you take advantage of dollar cost averaging and smooth out the ups and downs of the market. Finally, we differentiated between investing and speculating. Investing is a long-term commitment based on solid research and understanding, while speculating is more akin to gambling, based on short-term predictions and hunches. Always remember, sustainable wealth is built over time, not overnight. Investing is a journey, not a destination. It's a road filled with opportunities and challenges, but with the right knowledge and mindset, you can navigate it successfully. The key is to keep learning, keep growing, and keep investing. Remember, it's your money and your future at stake. So equip yourself with knowledge and you'll be well on your way to financial freedom.